Look at what the gold price is doing. It's sort of making new highs every day because people are realizing increasingly that we're in this world of monetary inflation. Debt ain't going away, and what's more, governments are not going to repay that debt. They're simply going to take out more debt, and we're getting debt on top of debt on top of debt, and hence it's monetary inflation.
Don't forget to sign up for a free portfolio review with one of our endorsed investment partners at wealthion.com/free. With markets hitting all-time highs, now is a great time to stress test your strategy and be prepared for what comes next.
Michael, thank you very much for joining us today. How are things in the great city of London?
Well, hi, James. Great to be here. I think they're pretty well. I mean, a few problems or tensions at the edges, but generally okay.
I want to touch on some of those edges in a little bit, but before we do that, I want to get your views on the global economy. And for those people who might not be familiar with your work, with you and your team at CrossBorder Capital, why don't you tell us what exactly you do?
Okay, well, our focus is almost entirely on looking at money flows or liquidity flows. We focus on the shifting money flows around the world, and particularly we construct measures of global liquidity. So we're really answering the question, money moves markets, and where is that money going? And that's really the sort of our big picture. The economy clearly matters, but it's not really the primary driver of financial markets. That's all about liquidity.
Right. So when you look at capital or you look at liquidity, it's going to go to where it can get the highest rate of return. And that's what you're trying to measure.
Yeah, it's basically saying that you've got two pots of money. One pot of money is driving the real economy, and the other pot of money is driving financial markets. If money is in one place, it's not in the other. All money that's anywhere must be somewhere, but effectively, we're focusing on that financial pool. And that financial pool, as you rightly say, will go to where returns are expected to be the highest. What we're seeing now is a market that is being driven by liquidity, lots of liquidity, in fact. That liquidity is continuing to expand, although we've got to bear in mind that it's been in an expansion mode now for, 36 months. So it's getting fairly long in the tooth. We've got to be concerned about some upcoming inflection.
So let's dig into it. We have a lot going on in the world right now. We have a government shutdown in the U.S. France appears to be in total chaos. The prime minister resigned just after 27 days in office, 5th PM in 2 years. The UK, there's a lot happening there. Every time I pull up social media, it looks like there's a mass protesting going on. And of course, in the country where I reside, Canada, it's like a sinking ship because of the policies put forth by this Liberal government in the last 10 years. And I know when you look at these events, you can't look at them in isolation. And that's why you and your team look at liquidity flows. So when you do that, what are liquidity flows telling you right now about the health of the global economy?
Well, I think you've got to step back and you've got to look at the long-term trends, and you've got to look at the cycle as well. And I think the messages can differ, but the underlying fact is that we're in an economy that is driven by debt. And that is really why a lot of things, I think, seem to many people unreal or surreal even. And that debt-driven economy is really acting in somewhat unusual ways. For example, if you've got a lot of government debt and a lot of government transfer payments going to the private sector, increases in interest rates can actually be quite a good thing because the private sector is getting more income from the government. So there are some kind of perverse effects that you've got to kind of wade through in terms of understanding this. But what we really got to come back to is, why is debt so large? Why is debt expanding? And how is that connected with liquidity? And the fact of the matter is that over the last few years, for various reasons, and those reasons are partly China, partly demographics, aging demographics, partly very low interest rates or zero interest rates, there's been huge debt accumulation. Now, the fact about debt is that debt doesn't really go away. And in fact, in a credit-based economy, you can't default debt because debt is collateral. So you've got to effectively keep rolling it over. And that rollover process requires liquidity. So effectively, what we're looking at in terms of understanding financial markets is that financial markets are refinancing mechanisms. they're no longer new capital raising mechanisms. In other words, they're not there to supply funds for capital investment, as the textbooks say. They're there to provide funds to roll over debt. And that means that the economy is sort of being wired in a very different way. And a lot of the reactions that people see happening in the economy seem, as I said, surreal or even perverse. Now, if you want to get rid of debt, or you want to roll over debt, should I say more accurately, you need that liquidity. And liquidity, therefore, is expanding. It's trending higher because debt is trending higher. So over the long term, what we're seeing is an expansion in debt and an expansion in liquidity. And that expansion in liquidity is what we think of as monetary inflation. In a world of monetary inflation, you need a very, very different asset allocation. You don't want to be holding government bonds. They're likely to be a very poor returning asset. You're likely to lose in real terms holding nominal government bonds. What you really need are hedges, monetary inflation hedges, things like gold and probably Bitcoin. Look at what the gold price is doing. It's sort of making new highs every day because people are realizing increasingly that we're in this world of monetary inflation. Debt ain't going away. And what's more, governments are not going to repay that debt. They're simply going to take out more debt. And we're getting debt on top of debt on top of debt. And hence, it's monetary inflation.
This October, Wealthion's putting the spotlight on silver with expert interviews, deep analysis, and a special in-depth report from our partners at SCP Resource Finance. To receive this report and other exclusive benefits, you can sign up to become an accredited investor with Wealthion at wealthion.com/accredited or by finding the link in the description below. Speaking of silver, Wealthion will be on the ground in Toronto for the SCP Resource Finance Second Global Silver Conference happening on Thursday, October 23rd. Legendary investor Eric Sprott headlines the event alongside 15 silver mining companies presenting their top projects. It's a must-attend for anyone serious about investing in silver. Tickets both in person and virtual are now available. Find out more in the description below.
And so right now you're sharing your screen and you have a slide up there called the global liquidity cycle. Maybe you can just explain that to us and what is it telling us?
Yeah, well, I've just spoken about the trend in liquidity. The trend is going up. It's growing exponentially. It's growing in line with the rise in debt. We know that debt is growing very fast. But on top of that, what you've got to understand is there is a cycle of liquidity. And that cycle of liquidity is really reflecting the short-term refinancing needs of an economy. So what you see here is a cycle of global liquidity. This is a cycle that goes all the way back to the mid-1960s. It's shown here as an index, and it's measuring strictly the momentum of liquidity that's moving through world financial markets. And we've overlaid on that graph a sine wave, a very smooth sine wave you can see as the red dotted line. Now that sine wave has an average frequency of around 5 to 6 years. That 5 to 6 year frequency is actually the average maturity of debt in the world economy. And that's why we're seeing this fluctuation in terms of that 5 to 6 year cycle. As you can see from the latest prints, we're at relatively high levels. That liquidity cycle, the black line, has actually shifted significantly higher since the low point that we saw in October of 2022. So from that point, we're really looking at 35, 36 months of expansion. That's quite long for a liquidity cycle, as you can see from history, but it has propelled markets higher. And the point that we keep reiterating is that, parce the real economies, and the fact that, economists, I suppose, are always scratching their head to say, is this recession or is this expansion? No one really knows right now. The liquidity cycle has been absolutely normal. It's been a very standard liquidity cycle. And if you look at financial markets have been behaving in an absolutely normal fashion. You look at asset allocation has moved strongly towards credit markets, equity markets. They've migrated through equity markets in a very normal sequence. So it's been technology first, it's migrated to financials, small cap have come through. Now we're looking at mining stocks and commodities. It's absolutely plain vanilla. What we've got to be concerned about, as that chart is illustrating, is we're somewhat near the peak of the cycle. peak of the cycle's not in yet, but this is what we've got to monitor very closely, because when liquidity inflects downwards, what you start to get are tensions in financial markets. It becomes more difficult to roll over debt. Those tensions express themselves in financial crises, and risk assets tend to plunge in value. And that's what we've got to be alert to. So at some stage in the next 12 months, you're likely to see Wall Street lower. You're likely to see Bitcoin coming off, significantly. You're likely to see gold pulling back. But these are probably, from our perspective, buying opportunities, because at the end of the day, liquidity is trending higher the whole time under this monetary inflation regime, and the need to keep rolling off or keep rolling over and funding debt.
And I'm sorry, Michael, how long did you say a typical liquidity cycle will last for?
5 to 6 years. So it says there 65 months, which is between 5 and 6 years. So let me just demonstrate first in terms of another slide, which is looking at the average length of a cycle. So this, let me stress again, is looking at liquidity. It's not looking at the real economy. It's not looking at the length of a stock market cycle. This is the length of a liquidity cycle, but liquidity is the driver of those two areas. Now, the dotted line is an average cycle, and that average has been measured over the 1970 to 2025 period. So it's a long span, and when we're talking of over 50 years of data. The red line is basically looking at the current cycle, the latest cycle. The low point of that cycle, the 0 point in the middle of the graph, was recorded in October of 2022. So you can see, moving from that middle point towards the right, how the cycle has expanded, and it's now effectively testing those previous highs or the previous peaks that we saw or we see in an average cycle. So that's what's been happening. Okay, we've got to be alert to the fact that what goes up comes down, because it's cyclical. Now, if you look at this slide, what it's telling you is that asset allocation process. We think of a cycle. The liquidity cycle is shown there. We also illustrate on the left the normal asset allocation cycle, how that tends to move. And what you can see is that we've divided the liquidity cycle up into 4 phases, but those 4 phases on the right-hand side relate to different asset classes. So equity markets tend to do really well in the upswing of the cycle, really between what we've labeled rebound and calm. The commodity area tends to pick up strongly around the peak of the cycle, so between late calm and the speculation phase. Cash does really well in relative terms, and absolute too, but certainly in relative terms on the way down as you move risk off, and it becomes more difficult to make money in financial markets generally. Cash is a good asset class then. And then long-dated government debt tends to do best around the trough of the cycle, when liquidity conditions are pretty tight and economies are just starting to roll down probably quite significantly. So that's how the cycle unfolds. Now, if you look at this following slide, which is a traffic light diagram, which basically says on the left, asset classes, on the right, industry groups within the stock market. This is how they normally unfold. Now, if you look at those 4 phases that we've identified, the 4, if you like, seasons of the liquidity cycle: rebound, calm, speculation, turbulence, you can see there in the rebound phase, so bear in mind this began in October of 2022, equity markets and credit markets are really the best areas to be in at that stage. As we move to the right, you move to the calm phase, credits start to labor a little bit. I mean, the returns start to weaken. And by the time you get to speculation, you want to be out of credits. Equities still do well in those first 2 phases, rebound and calm. Once you get to speculation, you get an amber traffic light, which is saying, just be careful here. Things are beginning to inflect. And then turbulence, you don't want equities at all. Commodity markets do well, as I indicated, between the calm and speculation phases. The green traffic light is there. You don't want them in rebound. You don't want them in turbulence. And bond duration, as I've labeled it, which is actually government bonds, long-dated government bonds, that they do well around the turbulence phase. Industry groups, you take a look at that. First half of the liquidity cycle, rebound and calm, you want cyclicals. That's the upswing. You want defensive stocks in the downswing. Technology does best in the first half of the cycle. Then you move through to financials around mid-cycle. Energy, commodities tend to do well around the peak of the cycle. Small cap does well late in the cycle. The dollar does poorly late in the cycle. International markets do best late in the cycle. What's different this time? Absolutely nothing. This is an absolutely plain vanilla cycle. And we see no difference. The economy, different question. Economy looks very different. Economies have flatlined in every region worldwide since the end of COVID. But stock markets, risk assets have gone up in a normal cycle.
Michael, a quick question. You said this cycle might end in the next 12 months or so, okay? And is that assumption all based on the typical length of a cycle?
It's based on typical length of a cycle. It's also based on something else which I'm going to turn on to, which is maybe this relationship. And this is saying, let's try and understand how financial markets work in this new debt-driven world. And what it says is that the heart of the system is liquidity and debt. The paradox that underlies this is that liquidity needs debt because liquidity is collateral based. And it says on that label on the left-hand side, using World Bank data, that almost 80% of all lending now is collateral based. Now that could be as simple as a home mortgage. It could be as complicated as a financial derivative that requires some form of government bond, US Treasury, to back it as collateral. So what you have is 80% of all lending worldwide is now collateral backed, and therefore liquidity needs good quality debt. But debt needs liquidity for refinancing. So you've got this spiral, if you like, or this axis that we can see in the center of that diagram. And what you need for financial stability is a robust or stable debt liquidity ratio. If you don't have that, you start to get a breakdown in the repo collateral markets, which are indicated on the left-hand side of the diagram. And the two factors to watch, or two indicators to watch there, are the move index, which is a measure of the volatility in the collateral markets, in other words, in the bond markets, and something called SOFR spreads. SOFR is the key interest rate in the US system. That has surpassed Eurodollar rates as the key rate to watch. And if that spread against Fed funds target starts to blow out, then you've got a problem. Now, to illustrate that, this is the chart that really underlies that. And this is looking at the ratio of debt to liquidity in the world economy. These are for the advanced countries, and this data goes all the way back to 1980. Now, what it says is that the average line there, which is drawn at about 200%, is where you get an equilibrium. So if the amount of debt in the world economy is roughly twice the amount of liquidity, you've got a stable environment where debt can be refinanced quite easily. If it goes significantly above that, so there's inadequate liquidity, you get refinancing tensions, and those annotations that I put on the chart illustrate where you get financial crises. They all coincide with very high ratios of debt to liquidity. So financial crises fundamentally in modern economies are basically refinancing crises, inability to roll over debt. Go to the other extreme, when there's ample liquidity, when the amount of liquidity is beyond what the debt markets need, then you get asset bubbles, because the vent tends to be risk assets. And what you can see is all those illustrations or annotations which illustrate bubbles. And what we've just come through is what we've called here the everything bubble. That's clearly been a huge bubble that has inflated everything over the last 10 years. It's been there for two reasons. One is that policymakers responded to every crisis by injecting liquidity. And secondly, they decided to take interest rates down to virtually zero, in some cases negative levels. And that meant that debt could be refinanced very cheaply. And so a lot of debt was termed out into the latter part of this decade. Now, in my years when I worked at Salomon Brothers, a US investment bank, 20 odd years ago, we were schooled on a book called The History of Interest Rates by Sidney Homer. That book, which is a sort of doyen of interest rate watchers, covers 4,000 years of interest rate history. Nowhere in those pages is there any evidence of zero interest rates. So what we've just had through the COVID and post GFC periods are an anomaly in terms of world history. That's how out of line we've been, and that has incentivized this huge take-up of debt. It's been a whopping great policy error, and we're likely to suffer from it. And that suffering is coming through monetary inflation. Now, what you can see on the graph is that the orange line starts to move up above the dotted line. That's saying that a lot of debt is coming due to be refinanced. And here is the evidence of that. So this shows the increase in the annual debt roll. This is the extra amount each year that the world economy has to finance in terms of extra debt coming due. And you can see this is counted in thousands of billions, so trillions of dollars, so 2, 3, 4 trillion additional each year. And this is bunched towards the end of the decade. So it really starts to pick up from 26 through 27. And that financing tension is going to be there, and it's going to be worrying markets. Now, is there evidence of that happening? Well, take a look at this. This is one of the indicators I suggested, which is the SOFR spread. This is looking at repo rates, repo interest rates in the repo markets, the refinancing markets, which are the key markets for monitoring financial stability. And that spread is shown against Fed funds target. What you can see there is a normal zone that I've put in grey, where that spread normally sits. And you've got a danger zone that I've indicated, that dotted line. And just look at the incidence recently or over the last year of increasing tensions in the repo markets. Now, this is something we've got to watch. They've climbed up recently and they breached that danger zone. What you're actually beginning to see now is evidence of them coming down a bit. But broadly speaking, that looks to be a worrying long-term picture. The other thing to look at is the MOVE index. This is showing volatility in the collateral markets. And what that is basically indicating is that you've got suppressed volatility at the moment. It's not a problem right now, but you can see what can happen. That volatility can explode. Now, in my view, what you're seeing right now is that the US Treasury and the Federal Reserve are actually deliberately suppressing volatility through buybacks of Treasury debt and other mechanisms. But this is a problem that if you squeeze a balloon, it tends to bulge somewhere else. So this is the danger we've got to watch. Now, the latest iteration is to start thinking in these terms. What is the Federal Reserve doing? And what does the Federal Reserve intend to do over the next 6 to 9 months? And this is showing the growth of Fed liquidity. Now, Fed liquidity measures the amount of liquidity that the Federal Reserve injects into US money markets this is on a weekly basis, but it's their weekly injections. Now, this is not the balance sheet. This is the liquidity injections, the liquidity driven part of the balance sheet. And what this is showing is you're actually moving to a period where you see a net contraction, a net withdrawal of liquidity by the Federal Reserve. And that is a worrying state to be in. One of the things that you've heard Secretary Bessent say, and you've also heard Stephen Miran say, the new FOMC appointee, is they do not want the Federal Reserve's balance sheet to expand anymore. They think that QE policies are reckless. They think they've destroyed the balance between wealth or the distribution of wealth in the US economy. It's been grossly unfair, and it's now Main Street's turn. So what you're starting to see, I think, is a shift, a subtle shift from Federal Reserve liquidity creation to Treasury, US Treasury liquidity creation. And that shift is pushing money into the real economy. And that is something the financial markets will have to suffer. This is the problem you've got upcoming, which is showing that the bond markets are already starting to suffer. The orange line is excess reserves of US banks, which directly derive from that Fed liquidity injection. So if the Fed liquidity shrinks, US banks' reserves shrink, and that's what that orange line is illustrating right now. And the black line measures the number of trade fails in the US bond markets. In other words, that's a failure to deliver bonds in a trade. If you get liquidity problems, there are a lot more trade fails. If there's a lot more trade fails, you get volatility. If you get volatility, there won't be so much lending, and the whole liquidity mechanism will start to shutter down. And this is the risk that the authorities are currently running.
So, Michael, there's a lot to unpack there, and I just want to make sure I understand what you're saying. So currently, under the current economic situation that we find ourselves in, the 10 years trading around 410, 420, the 30 year, I believe it's at 470, 480. And you're saying when we run into this financial crisis, it's because of the government's inability to refinance or roll over their current debt. And investors, I guess at that time, 1 year, 2 years out, they're going to say, you know what, 4% doesn't cut it, 5% doesn't cut it. We want 6% or we want 7%. Do I have, and these higher interest rates is what's going to cause this financial crisis. Do I have that right?
You have that largely correct, James. Yeah, I think the point is, one is that there's not the liquidity there to do the trading. So in other words, that markets they have a scarcity of liquidity. So there's actually an inability to buy debt or to do things. And you've got to remember that there is a huge amount of leverage in the system. And who has been the marginal buyer of treasuries in the last 12 months or so? It's been hedge funds. What we know is that traditional bond buyers, for example, the Chinese or the Japanese or international buyers, haven't really been there in the same sizes that they were. And so the Treasury has been very reliant on something called the hedge fund basis trade. Now, that's a fairly wonkish concept, but the fact is that hedge funds have been buying a lot of the debt and they've been shorting futures. And it's effectively a round-tripping exercise, but it has meant there's been underlying demand for treasuries. The trouble with that trade is that it's, number one, leveraged, and number one, dependent on low volatility, or number two, dependent on low volatility in the markets. And what we're saying here is that is at risk of unraveling, given what the Federal Reserve is doing or slated to do in terms of liquidity injections going forwards. And so there are some incompatibilities here in terms of policy intentions.
I like the way you framed that, incompatibilities. So, and why don't we talk about that a little bit deeper, because we have this conflict that's going on between the White House and the Fed. And the Fed has been very reluctant to cut rates. They did so just recently. They took it down another 25 points, first time since December of 2024. But then you have a White House that wants interest rates a lot lower. And you touched on Stephen Moran. He gave a speech not too long ago, and he said the current policy is way too restrictive. And he suggests, or the White House has also suggested, but cutting the Fed funds rate by 200 basis points. So you have this battle going on, and what will that do to this current situation? And I guess my other question is, if we do get in the next year or 2 years, if the White House does become, I guess, if they're able to control monetary policy, what does that do to inflation?
Okay, well, let's take those in reverse order. I mean, the first thing to say is, what about inflation? Let's think of inflation. And the way that we treat inflation is to basically separate inflation into two elements. The first element is what you would call monetary inflation. Okay, so that's devaluing your paper money. In other words, sort of trashing the currency. And that's broadly what's going on, because just take a look at the gold price. The gold price is soaring, and I'm going to show you a chart right at the beginning of this presentation, which highlights how the world has changed. And this is this chart. Now, this needs a tad of explanation, but it's pretty straightforward. And that's saying that if you look at that orange line, that's the gold price. Now, as we speak, the gold price is testing $4,000 an ounce, and it's likely to go higher. The black line is real interest rates. It's the rate on tips In other words, Treasury inflation protected securities. And what you would normally expect to see is that the gold price moves inversely to those real interest rates. Real interest rates have been plotted on the left-hand axis upside down to show that inverse relationship. So when real interest rates fall, that black line goes up. And when real interest rates fall, you'd expect the gold price to go up. When real interest rates climb, in other words, the black line on the page drops, you'd expect the gold price to come down. And the simple reason is that the cost of carry for gold tends to be, the opportunity cost rather, tends to be higher when you've got competition from real interest rates in the tips market. Gold obviously doesn't give you any carry. So if you look at that chart, I've circled the period in early 2022 when there was a very clear breakout or breakdown between that relationship. And what it shows is that real interest rates have actually climbed, but the gold price has just shot upwards. And that is, we're in a different world. And that different world is a world of monetary inflation. And let me just quickly illustrate what that problem is. That problem is shown here in terms of the fiscal deficit. And this is what I was saying right at the beginning about distinguishing the trend from the cycle. And this is the trend that the US is facing. But let's be clear here. This is what the West is facing. America may even be, one of the cleanest shirts in the laundry in this regard. If you're sitting in Europe, things look a lot worse than this. Viz France as we speak. It's a disastrous situation. But, let's be clear. Britain is in probably an equally bad state where we're going to be testing some of these frontiers in the next few weeks in Britain when there's another budget and everyone realizes that the emperor has no clothes. The fiscal situation is dire. What you're looking at here is the structural deficit, the fiscal deficit in the US as a percent of GDP. Now, these are not my figures. These are figures that come from the Congressional Budget Office. All we've done here is to basically up the figure they've put in there for defense spending. So we assume that defense spending goes up to 5% of GDP, which is the NATO target. I think that's probably a reasonable assumption given what's going on. And that is the difference between our numbers and what the CBO is saying. But broadly, what you're seeing anyway is a big increase in what we call the structural deficit. The structural deficit comprises Social Security, Medicare, defense, and interest payments, okay? So things that you can't effectively avoid. So they're structural. There's no discretionary spending in this at all. That structural deficit is climbing. It's trending higher. The black dotted line is debt as a percent of GDP held by the public. Look at that. That just grows exponentially. We're currently about 100%, but by 2050, I'll be long gone by then. But, hey, 250% of GDP. Our grandkids are going to be, absolutely stuffed and wrecked by this policy. And this is why gold is going up. Now, this may be a heroic assumption, but this is basically what's going on. And what you see here is, again, that debt to GDP, the black dotted line. And what I've said is, let's just keep a simple model here. Let's say that the debt burden that the US faces is constant in gold terms. Is that realistic? Well, I think it's pretty realistic. Since year 2000, US debt has increased by around about between 9 and 10 times. So the stock of federal debt is 9 to 10 times, just pause and think about that, higher in 25 years. That's a big jump, okay? What's the gold price done? It's gone up 13 times. So gold has more than kept up with federal debt. So this is saying, let's just keep that relationship constant. And what do you see for the gold price? It just grows exponentially. So if that's the right relationship, which I think it is, you're looking at, by the mid-2030s, a 10,000 an ounce gold price. That should focus the mind. So that's the monetary inflation element. In terms of high street inflation, you've also got to take into account what's happening to costs. Those costs could be oil prices. They could be the benefits of technology. They could be cheap Chinese goods, or maybe now more expensive Chinese goods. So put those two elements together into a cocktail, monetary inflation and costs, and then you've got some idea of what high street inflation is going to do. And I would suggest that high street inflation, because of this big monetary inflation, is going to, in the medium term, going to be higher than we've been used to in the last decade. I don't think it's going to be dramatically higher. Let's be sure. We're not going to get hyperinflation, but we are looking, I think, at significantly higher rates of inflation. And after all, isn't that what the politicians want? Because they want to try and devalue this debt. So that's the picture, going back to that part of the story. Now, to pick up, I think what we were saying back here in terms of the cycle, what you've also got is a problem near term, because you've got this downsizing, if you like, of the Federal Reserve, and you've got this upsizing of the Treasury. And the Treasury, if you take a look at this chart, maybe it's a tad wonkish, but it basically is saying, look, you can inject money into the system, not just through the Federal Reserve, the Treasury can do it too, because the Treasury issues Treasury bills. And if those Treasury bills, which they are, tend to be bought by banks, that is monetization of the deficit. So effectively, banks' balance sheets expand to take in Treasury bills, and that expansion in banks' balance sheets is an expansion in money supply. It's a monetization of the deficit. So this chart is saying, look, the red line is traditional QE, okay, Fed expanding its balance sheet. The orange bit is what we tongue-in-cheek called not QE, which was basically the Federal Reserve protesting and saying, well, actually, we're really shrinking the balance sheet. But the fact is they were injecting money through the back door, through the reverse repo account, the Treasury General account, the Bank Term Funding Program, and all these other acronyms. They were doing that, the orange area. That's now been exhausted pretty much. And so what's left is the black area, which is what we call Treasury QE. And that is the Treasury basically printing money by issuing Treasury bills. And that's on the up. Now, why is that so important? Because that aligns exactly with what Treasury Secretary Scott Bessent and Stephen Miran are basically on about when they're saying they want Main Street to benefit, no longer Wall Street. So this money is being channeled by the federal government into US industry, and it is basically doing things like taking stakes in corporations, increasing defense spending, etc., etc. It's targeting industries. It is part of the Make America Great philosophy, but this is coming driven by the Treasury, not by the Fed. So it's not the Federal Reserve just hosing liquidity into the system willy-nilly and asset prices generally rise. This is designed to be focused spending on specific industries.
If you're looking for a simple, secure way to invest and own physical gold and silver, visit our sister company, Hard Assets Alliance, at hardassetsalliance.com. That's hardassetsalliance.com.
Michael, you mentioned earlier that debt as a percentage of GDP is around 100%, and it's going to grow significantly in the coming years. But you also said that governments never really repay their debt. All they do is just roll it over or keep refinancing it, and it just keeps growing. And I believe when Trump first came to power in 2016, the federal debt was around 19 trillion. Now we're at 37 trillion or 38 trillion. It's growing by a trillion every 100 days. But if that's the case, then so what if the debt to GDP goes to 150 or 200%? As long as your economy keeps growing, you can service that debt and just keep doing the same thing on and keep kicking that can down the road.
Yeah, I mean, I agree with you. I think you can, but it comes at a cost. I mean, nothing's there's no such thing as a free lunch after all. But the cost is you get monetary inflation. And what's monetary inflation doing? It's basically devaluing paper money. And by that may be what they want to do. And therefore, what you've got to think about is holding assets that are monetary inflation hedges. And those monetary inflation hedges are things like gold or Bitcoin. And, as I've said, look, just take a look. Since this big increase in government debt, it's not just Trump. I mean, this has been going on, for decades. But broadly speaking, the big increase in debt occurred from about year 2000. Now, we can go back and argue why is that? is that all to do with the rise of China, allowing China to get in WTO, et cetera, et cetera? I think there's an awful lot to go to that. That explains a lot. It explains why interest rates were cut, incentivizing debt, et cetera, et cetera. But the fact is that debt has gone up by almost 10 times since that date. How much has the S&P gone up? It's gone up less than 5 times. How much has gold gone up? It's gone up 13 times. The S&P is a pretty decent monetary inflation hedge, but gold is a lot better, and you can see that. And if you want to preserve your wealth, you've got to put money into gold to some extent. And I'm not saying everything, and I'm maybe not even saying as much as 50%, but I'm saying that you've got to have a decent slug of gold, or you've got to dedicate one part of your portfolio to these monetary inflation hedges. And that could be prime residential real estate, it could be gold, it could be big or large cap companies that have got pricing power, it could be Bitcoin. But all these factors, they're not government bonds, and they're not small cap equities, which are likely to lose money over the long term in this environment.
So why don't we have a deeper discussion on that and how we can protect our portfolios against the ravages of inflation and money printing? You touched on gold. It's up 40% on the year. Looks like it's going to keep going. We're making new highs every other day. Where do you see the gold price going?
Well, I mean, I'm going to cheat and go back and say, look, the gold price is going to do pretty much what I'm indicating here. If I can get back to that chart, look, that's public debt as a percent of GDP, and the orange line is the gold price, assuming, and this is the assumption, that federal debt in gold terms remains constant over that period. So what that's saying is that gold is just matching the increase in government debt. Simple as that. And actually, we know from experience in the last 25 years, it's done better than that. So maybe I'm being conservative here, but what it's saying is, you read off from that chart, you can see on that left-hand scale what gold does under this policy. Now, do we actually get 250% debt to GDP by 2050? Well, you tell me, but you think it's possible. I mean, certainly if you take Japan as a benchmark, it's more than possible. Governments won't have any problem funding it. They can always fund debt. The question we're saying is at what price and at what cost? And the cost here is monetary inflation. The value of the dollar is destroyed. But then, hey, that's history, isn't it? I mean, how much is a 1914 dollar worth now? It's pennies. But that's the history of credit systems. That's what we know. But the other thing we've got to say is that let's think out of the box here and say the US is not the only country in the world. It's not the only country in the world with problems. Some countries have got even bigger problems. I alluded to Britain. I alluded to France. But there's another one out there which is even bigger, which is China. And let me just shift on to China. China's problem is too much debt. And we saw earlier on the debt to liquidity ratio for the advanced economies was very low. This is in orange, the debt to liquidity ratio of China. It's very high. China's got debt problems. We know that. China has problems refinancing the debt. We know that. There's a lot of tensions in Chinese financial markets. They've got to get that down. And the only way they get that down is to do what Japan did a few years ago. Japan's in black here. It reduces its debt to liquidity ratio, not by defaulting on the debt, because that's not allowed. You do that by increasing liquidity. So what is China doing? It's increasing liquidity. This is the 6-month change in liquidity injections by the People's Bank of China, the PBOC. And what you can see there's a huge step up in those liquidity injections. And to put that into context, this is over the 6 months, 6 to 7 thousand billion yuan is close to $1 trillion. So this is a big jump. I think they've got to do exactly the same again, at least another trillion to put into markets. And what does that mean? Look at this one. This is the yuan gold price. Now, I would argue, and I'm sure many would disagree with me, but I would argue it's China that's setting the gold price, not the West. And China is controlling the physical market now. It's a big buyer of physical gold. The Shanghai market is now the preeminent physical market in the world. London may be, more dominant in other dimensions, but certainly in terms of physical gold, Shanghai is there. Chinese residents are allowed to own gold; they can't export it. And I think that what you're getting is a vast accumulation of gold in China officially. It's not being disclosed, but it's happening. The Chinese are buying whatever gold they can at whatever auctions occur. This is the yuan gold price. Our view last year was that it had to at least get to 24,000 yuan per ounce to actually begin to eliminate China's debt problems, devalue paper money against those debts. It's got there. It was trading in that trading range for about 6 months. It's now broken higher and we're going up again. So I think they want the gold price up. And what I would surmise, and I could well be completely wrong here, is that what China is trying to do is to reconstitute its money around gold. So gold will feature in some way in the Chinese financial system formally, and that will be a great incentive for people to invest in Chinese yuan, in the Chinese yuan and Chinese assets. And I think that's what the end game is here.
Very interesting. So you're very bullish on gold. Any views on silver? And maybe we should also touch on Bitcoin.
We can touch on silver because silver is just a leverage play on gold, and silver has been depressed for so long. If you recall, back in 1980, the Hunt brothers tried to corner the silver market. Silver got to $50 an ounce. And where are we now? We're actually back at those levels. So we're almost back at the highest level we've had for almost 50 years. So silver is going up, and it's probably going to go up a lot more. So I think that silver is certainly something to have a look at under this regime. But look, I mean, we've got to be straight here. Markets never move in straight lines. And if there is a pullback, buy on the dip. But, don't go all in when the market's racing. Just be cautious. Play the trends. That's the important thing to look at here. So that's gold. Generally, this chart, the next one, is showing Chinese liquidity, which is the orange line with my projections as an index against world commodity prices. So if China starts to inject a lot of liquidity and it gets the Chinese economy revving up again, you are going to see commodity markets move higher. They're already doing that. Generally, think of what the copper price has been doing as well. I mean, silver is an industrial metal as well as a precious one. But you're starting to see a lot of commodities beginning to get traction, with the exception right now of oil, but oil might be very political. So let's think about Bitcoin. Bitcoin is a monetary asset as well. And this is the relationship between Bitcoin and global liquidity. Global liquidity is shown as the black line. This is a very short-term indicator for sure, but a lot of people like to look at this because many people trade Bitcoin. And what you can see is movements in the black line, global liquidity. The line has been advanced by 3 months, and the orange line is the change in Bitcoin prices, if you like, 3 months behind. And what this is basically saying is that, whenever global liquidity picks up, Bitcoin shoots higher. Whenever global liquidity comes down, Bitcoin comes off. And if we say, first, the global liquidity is expanding dramatically over the medium term, you want Bitcoin in your portfolio for sure. If we're saying we're concerned on a 12-month view that something is going on with the Federal Reserve that may cause some tensions in markets, then you want to be a little bit wary about going all in right now and think about trading more prudently.
Okay. I'm sorry. Did you say you have a target price on Bitcoin? Where do you see it going?
Well, I didn't say I had a target, but I mean, look, Bitcoin, the way to think about it is that generally speaking, if you go back historically, the relationship between Bitcoin and global liquidity has been very high. So in other words, there's been a multiplier of about, on average, going back over the last decade, about 5 times. In other words, if liquidity has gone up 10%, Bitcoin's gone up 5 times that, 50%. Okay, that's the normal relationship. If you look forward, you can see that relationship is attenuating. It's becoming more. It's becoming lessened, but it's still very positive. And our view going forward is that that relationship is about 2 times in the medium term. So we will argue that if you get a doubling of liquidity over the next few years, which after all is not a big ask. I mean, that's basically growing at just over 7%, per annum. So liquidity, we think, is growing probably a tad more than that. So liquidity is going to double probably about every 7 to 8 years. And that would say that Bitcoin, if liquidity doubles, Bitcoin's going to go up 200%. So that would be my target.
So your primary message is you got to get long scarce assets late in this cycle here, gold being number 1, Bitcoin being number 2, or real estate also.
Well, I think you've got to, I think to be accurate, what I would say is you've got to take a long-term view of this, or a medium-term view, and you've got to think about the trends. The trends have changed. We are in a monetary inflation world. We're not, as some people argue, in a world of financial repression. That is the wrong way to look at it. It's a world of monetary inflation. In a world of financial repression, you don't necessarily want gold. You don't necessarily, you can hold many other assets. But in terms of monetary inflation, you want monetary inflation hedges, dedicated hedges. And those are things like gold, Bitcoin, large cap equities with pricing power, things, in the technology space makes sense. I would add in that, US defense companies could be a great buy looking forward, particularly some of the higher tech ones. And you start to look at, things like, Bitcoin, if I didn't say that, Bitcoin as well. These are dedicated monetary inflation hedges. That's what you want in a core of a portfolio. In terms of trading, what I would say is that I would be watching pretty carefully, because I think we're coming towards the peak in the liquidity cycle. We're not there yet. Market's going to keep running as far as I can see over the next few months. But the fact is, the plain fact is, the Federal Reserve is slated to take liquidity out of the system. That is what they're telling us they're doing. That is what Scott Bessent is insisting they do, and that falls into the Stephen Miran, "Make America Great," thesis. So, why should we argue with them? That's what could happen, and we are therefore watching the liquidity cycle in the short term for some sort of inflection. I'm not saying bail out now. I'm just saying be cautious. Don't chase risk too aggressively, but play the long term. Think about, or buying on weakness, any weakness, if you start to get these assets coming off, because the trend is compelling.
Michael, when we started this conversation, I was asking you about London and how things were, and you said for the most part things are pretty good, but there is a little bit of tension around the edges. So I want to have a deeper discussion on what's happening within England. And every time I pull up social media, it's like there's mass protesting going on, and people are very angry. Maybe you can just give me a quick overview on what's happening there from a political point of view and also an economic point of view, and why people are so pissed off.
Well, I think the answer is yes, 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 and yes. I mean, it's all happening. There are bigger tensions in Britain than I've seen in 50 years. That's absolutely clear. There is a significant revolt against government policies of allowing mass immigration. The sort of chickens have come home to roost here, but I think that's not just a UK phenomenon. That's happening in Canada, it's happening in the US, it's happening across Europe. So, this is, we're all part of the same bundle in that regard. But it maybe is more exaggerated in the UK. And what's more, the media is being suppressed in terms of its full reporting. That's absolutely clear. If you drive around, the shires of England, what you see is on display masses of St. George's flags. Those are the flags with the white flag with the red cross. The flag of England, and people are demonstrating their feelings, very clearly by strapping these to lampposts at heights where council workers can't tear them down, and that's broadly what's going on. People are trying to state, their pride in the country, and they think this is being diluted by deliberate or surreptitious, I would say, government policies. So that's absolutely good. That is going on. And I think a lot of the stuff that you hear on social media about the mainstream media and the government suppressing news about this is absolutely factual, because you can just see walking around, there are demonstrations. But as I say, this is not just UK local phenomenon. This is a phenomenon that you've got across Europe, and you've got in the States, and generally in North America. So ditto there. I think the problem in the UK is that the UK is suffering from a budget crisis, or certainly soon will. The socialist government don't seem to understand basic economics, but that's the history of socialism. The fact is that they are overtaxing people. They're spending without any control. The budget is likely to be blown out again when the budget statement comes in November. Taxes will go up, but the bond market is vulnerable. We can see what happened to France. We can see what's happened to Japan. And we've got to think about bonds in this global context. So, everything I've said about the US has got to be framed in this idea that, or this fact that global bond yields are on upward pressure because governments just want to spend. They've out-taxed us. We're on the declining phase of the Laffer curve in almost every Western economy, and therefore they've just got to print money. And that's why this whole issue about monetary inflation is so live. And part of this whole immigration issue. I mean, I wrote a Substack post on Capital Wars recently about this. Is that you've got sky high house price to income ratios in a lot of countries. It means that young families can't afford housing. That means that birth rates come down, which means you get labour scarcity, which means governments encourage more immigration, and therefore you get the problem just spiralling out of control. And that's what we're seeing. This is, a response to past monetary inflation, if you like, which has caused sky-high house prices, which has outpriced families. It's causing declining birth rates, increasing immigration, more social tensions, and there we are, vicious circle.
It sounds like England is suffering from many of the same problems that Canada is suffering from. But I was recently in London, and I think one thing that really stood out to me was inflation. And I mean, this is everywhere you go in the world, but I was just there a year ago and I noticed a big difference just over that 1 year. And I took a cab from Heathrow to downtown London. It cost me £100. And I always find this is a good benchmark of inflation in whatever city you go to, what it costs to get a cab from the airport to downtown. A similar ride in Toronto would cost me $80. Okay. In New York, probably $70 or $80. And yet in London, it was £100, which is 200 Canadian dollars.
Yeah, it's out of sight. But you're absolutely right. I mean, I always used to take a great benchmark cab fares around the world. It's a very, very good guide to inflation.
Well, Michael, this has been a great discussion. I want to thank you once again for spending time with us today and sharing your thoughts on what's happening. If somebody would like to learn more about you and the services that your firm offers, where can they go?
Okay, well, there are two routes. One is Capital Wars, which is a Substack, and you'll see that CrossBorder Capital has been rebranded on these slides as GLI, which is Global Liquidity Indexes. That's because we are, if you like, emphasizing the data component of what we offer, and you can contact us through the website to get access to that. But that's really an institutional service where we provide a lot of data on global liquidity measures in 90 countries.
And you're also very active on X or Twitter. What's your handle?
Yep. Handle is @CrossBorderCap.
Michael, once again, thank you.
Great pleasure, James. Enjoyed it.
Don't forget to sign up for a free portfolio review with one of our endorsed investment partners at Wealthion.com/free. With markets hitting all-time highs, now is a great time to stress test your strategy and be prepared for what comes next. Thank you all for watching. We'll see you again next time.